You've learned the basics of ICT and smart money concepts, but you still don't know how to find an entry. A major problem within this space is that everybody's worried about fair value gaps and order blocks and daily bias, and while these are very important parts of trading, they alone do not help you execute a trade. And if we can't execute, then everything else is pointless. So in this video, I'm going to show you a strategy that I use to get funded with my Forex funds with a $300,000 trading account. It's able to trade crypto or Forex, and you can trade multiple different pairs without having to sit and watch the screens all day long. And the most important part of it is that it is mechanical and simple. I can't stress enough how much you need to take everything you've learned from ICT and smart money concepts and put it into one strategy that you can actually act upon. Enough of the chit chat, let's go ahead and get into it. What is the basis of my plan? Kind of just things to keep in mind, the basic rules, and we'll get into the processes after. So the trades you want to execute are going to be, first off, the number one way to refine your edge is going to be only watching through certain times a day. So you're going to only want to be executing during London and New York session only for this strategy. I think most strategies are best with only London and New York. And if you want to refine your edge even more, you might say, okay, well, I only can trade New York. I'm limiting it to New York. You might get less trades, but you're also going to possibly be able to gather data that says, maybe London's better, maybe New York's better. And it's going to be different for every single strategy and every single pair. So another thing you want to do for this is cancel your limits or de-risk your positions if there is upcoming high impact news. We're going to be using order blocks for this strategy, and we're going to be using the entire range. So what does that mean? Let's say if we have a price range like this, and we have this down move before an up move. So let's say there is a candle right here, just the last candle. So this is the last down candle before the big push up. And if you're not familiar with what I'm talking about with order blocks, you can watch some of the first videos in this this series, the supply and demand videos. Supply and demand order blocks, they're just different terms. So you can use, sometimes in some strategy, you might just use that last down candle. And we talk about that in those older videos. You'll get more insight if you watch that. But what we want to do in this strategy is, let's say we have this down move, and then we get a break of structure. We want to use the entire range for our entries. So whenever we are looking at the chart, we're not going to try to pick the last candle. We're just going to use the last range, because the logic that I like to use basically is, if smart money pushed price down and took out these lows like that, and then pushed up, we know that smart money was buying all through that down move. So we want to look at the entire zone for mitigation. It also makes things simpler. And this is just something I've tested for swing trading, that if I'm swing trading, I'm not going to want to, overanalyze and make things complicated, because you're not going to get that many trades. And usually the trades are pretty high risk to reward. So you don't have to worry about a couple pips difference in trying to pinpoint the bottom candle. Now that's just for this strategy again. And you can take any of this strategy if you want to test it, and go test it using different rules. That's how you develop and define an edge and continuously grow and refine your trading plan. We want to use closes to ensure displacement. So this is really important. You don't want to just use a wick for what we determine as displacement. And I think any trading plan you use should have displacement incorporated. So the reason we use displacement is to confirm that smart money is involved in this move. So if we have just a move down and then a little pip up, and it kind of coils up, barely pips it and comes down pretty hard, we're oftentimes going to see new lows. You want to see that big exaggerated move, and that's where you want to get a big push, because we're looking for institutional involvement, and displacement is a great way to identify when an undeniable force has entered the market. In order to keep our profits growing and make sure we can account for any losses, because any strategy is going to have losing streaks, so to speak, we want to make sure we have a 3 to 1 risk reward minimum. So that means if you find the setup, but it's a 2.5 risk reward, we don't want to trade it for this model. Now, you may be wondering why I say that, because I do trade lower risk reward models. This is not one of those strategies. And that's a good example of how everything can change from one strategy to another. So in this one, we're going to want to use a 3-to-1 risk to reward. We're not going to break even stops unless the trade is over 5-to-1. So if the trade is over 5-to-1, we're going to trim 30% at 3 risk to reward to de-risk. So just to give you a visual of what that would mean. So let's say we're in a trade and it's 5-to-1. We're going to mark out where 3-to-1 is, regardless of liquidity or fair value gaps or any targeting strategies. And we're going to take off 30% of the trade right there. So what that does is if we're risking 1% of the port or 1R, whatever that may be, we at 3R and we take 30% of 3R, we're getting just a little bit under 1% of the port gain, but we're also taking off some of our position size. So if the trade does reverse and hit the stop loss, it's going to be a little less than a 1R loss. So you're basically balancing yourself out to where you can keep the same stop loss, but you're not going to lose money if it hits. So, theoretically, if the trade does this and gets into your, I drew that weird. Say it comes down in here and it hits your limit and the trade goes up, boom, it hits 3R, you take 30%. Now you're able to, if the trade does come down back to your entry before it goes all the way to the TP, you're not just going to get stopped out at entry, because when you're using order blocks for entries, a lot of times another order block is going to be created at your entry if you're correct. So there's not necessarily anything wrong with price returning down to your entry. And it really sucks to get stopped out only to watch a trade go, in the direction without you. So what that does is it allows you to de-risk, but it also mitigates the possibility of you losing out or missing out on the trade. I think this strategy is a good one to risk 1%. Reason being is we do not have a ton of trades. Now, again, if you're watching 5 trades or 5 pairs on this, you could probably get up multiple trades a week. But again, the more you put yourself out there, the less, the more dull of an edge you have. Now, again, it depends, what pairs you like to trade. So again, I recommend major Forex pairs and major cryptos for this. So we're going to be focusing on trying to trade with the 4-hour time frame. So that's not going to be the highest time frame we use, but we're going to want to move with that river, so to speak. And hopefully you guys get a little insight on how bias is overcomplicated, because we're going to use a multitude of different things to establish a bias that isn't just the daily chart. So this is going to be a little bit of insight, and this may complement you in other trading plans. So pay attention once we get to the bias part. So the first thing we're going to want to do is we're going to want to draw our weekly and daily structure with premium and discount. So what this does is it gives us a context to operate within. So when I tell you guys, somebody just sends me a chart, they'll send a chart and say, what do you think about this? I'm never going to be able to tell you because I don't see the next chart up. I don't know where you're at on the weekly or the daily. And you shouldn't look at it from a one chart perspective either. Now we are going to be using a certain couple time frames mainly, but we want to be operating in context of those daily and weekly charts. And that's any trading plan you have, no matter what, you should be doing that. So I've already mapped out some of the structure just to save time. So if we're on the weekly chart, which is where we're at right now, all I want you to do here is mark out our weekly and daily structure with premium discount. So we're going to mark this out. We're going to get onto order blocks in a second, but basically right now we're drawing the weekly structure and then our premium discount. So if we look here, we can use some of our other, this is where it gets a little discretionary because every style is going to have, or every strategy is going to have a little bit. So this is when we're operating in context of the weekly, context here would be, okay, we just took out a low. We're in a discount of the range. Sometime soon, we're probably going to start reversing up. So at this point, the 4-hour might be bearish, but we're expecting it to most likely reverse here soon. So if we see that reversal, we're going to know that that's in context of our weekly chart. So we will be able to position ourselves with the 4-hour trend before waiting for a major reversal. So after we hit the weekly and do our external structure and kind of just get a little bit of context, we've taken out this low, we have a high, and the reason I picked this high for our external high, so remember, whenever we're talking about external structure, it's the most recent 2 points that have created structure. So there's also the strong high weak low theory. So basically, you would have had this would have been your old range, this high and this low. So once this low is taken out, we're going to look for the highest point between this low, and the new low. So when you do that, you're able to say, okay, this is the major external structure we're operating within. So you're always going to want to be aware of where you're at in that ballpark. So after that, we're going to go down to a daily, and we can do the same thing. So daily external low is going to be the same as the weekly. Just pushing out here so you can see it. And then our external high in the daily is going to be right here. So now why did I pick right there? Again, it's the same thing. If we're looking at our daily structure, it's obviously going to be a little bit more tight than our weekly structure, right? So we're going to be looking at where we had a major pullback. This to me is not going to be a daily new high. This is not a daily swing. If we look at the pair, we have pretty big moves in between swings. Now this one is a massive move, but again, we're operating in context that weekly. We were going for that weekly sell side liquidity at that low. So the daily has shown desire to move up. We're getting closer to a premium, but we got to remember the daily operates in the context of the weekly. So the weekly is in a discount, and we just took out sell side. We're obviously moving back to a equilibrium or a fair market value or a premium, right? So that's going to automatically give us somewhat of a bullish bias. So off rip, now you've just looked at the daily and the weekly, you've got a little bit of a bullish bias. So again, the next thing we want to do is mark out our order blocks. So we've already marked out our liquidity. You can be mindful of internal liquidity as well. But again, we want to keep this as simple as possible. So after this, we're going to mark out a weekly order block up here, right? And we're not going to get all the way up here. I'm not going to mark out every single one. Obviously, there's more up here that's irrelevant to us right now. We're nowhere near that. So again, we want to, after we've marked out our daily and weekly structure with our premium discount, we want to mark out order blocks. Again, we're going to be focusing on order blocks, the strategy. We don't want to be getting, it's all about defining that edge. Are there fair value gaps? Are there breaker blocks? Yes, there are. But if we're watching every single one, and the more you're spreading yourself out, the less opportunities you're going to catch, and the more indecision you're going to have. It's like the term paralysis by analysis. And that happens to a lot of people, especially with smart money, because it's like, oh, well, it might do this, but if it does this, then it's going to go here. Or if it does this, it's going to go here. And you just sit there and don't ever do anything. And it's, we're here to make money. So we don't want strategies like that. The more you can get away from that, the better. We're on the daily chart. We marked out that weekly order block. We've got the weekly and the daily high. You can't really see it because they're the same high, right? That external high. And then if we look at the weekly, that's going to be equal highs. So we know this is a point where price is A, likely to draw, and B, also likely to see a retracement from. So again, why are we saying it's likely to draw there? Well, if we look at the weekly range, we have equilibrium right above it. So if the weekly has taken sell side, has formed a swing low, we're obviously going back towards a premium. So what else can complement that bias? Liquidity, order blocks. So we could say we're going to target these highs and potentially see a reversal in that weekly order block. So if we're down here, we're going to be looking at a bullish bias because I've already said, I'm like a broken record in my head with the weekly sell side and reversal. So what we're going to do now after this is we're going to plot our 4-hour internal and external structure for our immediate bias. So we already have the context that we're pretty bullish. So once we hop into this next chart, we're going to say where are our swing highs, just like our external highs, and where is price expanding from, because that's where we're going to look to get active. So if we go to a 4-hour chart, what we'll do here, just to give you guys a better visual, I'm going to turn off replay mode so you can get a little bit more a visual. And yes, it's hindsight. I hate only, we have I can't teach this in a live market. This is how you develop strategies like this, is by, using hindsight. So I'm not going to sit here and tell you I took every trade or that I would have taken every trade without this strategy, but this is how you develop a strategy. So I'm going to go ahead and I'm going to show all of the structure in a 4-hour. So I'm going to hide this daily range just because it's in the way. So whenever we're looking at the market, we want to do the same thing that we did with our daily levels. We're going to look at our 4-hour and say, okay, where are we taking out highs and complementing that bullish bias we found on the weekly and daily charts, and how are we going to operate off of that? So let me go ahead and take off some of this from the chart so we can see a little bit. So now we know we're bullish overall, and I know looking back, obviously it's bullish throughout, but down in this area was when we had taken out that external low, and that's when you would have developed a bullish bias based off of the weekly chart. So whenever we look at the 4 hour, we're going to say, when did we start taking out highs right here with displacement? Now, again, we're using closures. So if we get a closure above this move, we're looking at that as a new point of structure. So the idea here is you're going to want to find, where did we expand from the most? And you're also going to want to use premium and discount. So we want to see price return to a discount. We're not always going to see that happen. All right. So sometimes you're going to miss trades. That's okay. That's part of the plan. And you have to be able to watch the trade go without you and not chase it. So what we're going to do now, mark out our 4 hour zone. So structure, I'm not going to plot every single bit of internal structure. So like for instance, here we have a high, a low, a high, a low, and we take that right there. We look for what caused that, because we're operating in context of the last zone and the expectational order flow. So here we took out a high, so we're going to be targeting this high. That's going to be our draw on liquidity. I talk about in the streams a lot how draw on liquidity is basically just bias. It's a really overcomplicated strategy. When we're talking about draw on liquidity for this strategy, we're not really putting a specific time on it, but it's more of a midterm draw, more of a weekly draw a lot of the time. So weekly or monthly draw. So all through here, if we look, this was a long time. That's 21 days. So again, we're not talking about intraday. We're not talking about where price is going straight to it, but we're able to build a bias. Now, another cool thing about this strategy is if you are day trading any of these pairs, it's going to complement whatever bias you had. And you're going to have a little bit different of a perspective than if you're just, kind of looking on the 1 hour and the daily chart. We're going to look at our external structure. We know that price is likely to move from internal liquidity to external liquidity and then back to equilibrium. So what does that mean? In this range right here, we have this low and this high. So where is the internal liquidity? Right there, because it's internal to this range, right? So price, again, it moves from external liquidity. We took it, or I'm sorry, let's do this range so it's easier. We went from internal liquidity right here to external liquidity, which was here. And then if we mark out, we went back to a discount. So this cycle is going to repeat itself. And that's why it's really important to use points of interest or order blocks at a discount of a bullish range and vice versa if we're in a bearish range. So delete some of these drawings. So after we plot that out and we are aware of where we're at on the weekly and the daily, we know we're bullish. The 4 hours telling us we're bullish. We're just looking to get long off these 4 hour zones. So the next part of the strategy is that we're going to wait for price to travel to an unmitigated 4 hour order block that caused the most recent break of internal structure with displacement. So whenever I say break of internal structure, it's not every single one. We want to do the one, let me type this out just so people that are watching this, and correct market extreme. So what does that mean? Well, if we're looking to long, we want to watch for the internal change of character or shift of market structure in a discount, because we know that price, again, it moves from internal liquidity to external liquidity back to a fair value. So again, if we've already taken external liquidity, which gives us our context and our expectational order flow that price will continue up, we want to make sure we come down and take out that liquidity, move into a discount, and then move away from that. And that zone, that's going to be our point of interest, so to speak. We're looking at the 4 hour chart here. We have a bunch of opportunities and one missed opportunity right here. So I think there's actually 2 missed total, but one that you can see, one that never hit the 4 hour zone. So now we're going to mark out how many trades there were. And you can see this is over quite a long period of time. And this is why I recommend you do watch more than one pair. So let's say after you had established this bias, if you adhered to the strategy, you only had 3 trades in almost 3 months. Now, it seems like most of the trades happen in a short amount of time. That's going to be, it happens really within the first 2 months. And if we look at the time from the first trade to the last trade, it was only 1 month. So again, with a swing trading strategy like this, I don't recommend you just watch one pair. Now, if you did take all 3 trades, you got 3-to-1, 6-to-1, and 4-to-1. Now, if we really think about it, let's say if you're on a live account and you got 12 or 13 R over a 3-month period, that's not bad. It's not like home run, insane stuff, but that's definitely paying the bills if you're on a larger funded account. So don't get it twisted that this isn't enough. I don't want to inspire over trading, but I do want to be more realistic and know that it's hard for people to only take this many trades. And if this strategy, if you do it correctly, you can get still a good edge on multiple pairs. So We have that break of internal structure, and look at that displacement. That's a big move. So we're going to say this last little zone, we know there was institutional involvement there. So we're going to want to watch that zone. After price does that, let's go to a 15-minute just to, we know we're operating within this range right here, here, and here. So we're looking to get long anywhere in this range where we know that we're likely to go take out these highs. So we have that displacement where we get that internal shift of structure. That tells us the market is drawing up to something. We've already determined our draw on liquidity. We're just going to use structure and displacement to tell us when we're moving that way. Oftentimes it's going to happen in a discount. So we move there. This is our 4-hour zone. We're not going to worry about refining zones. You can do that maybe if you want, but I don't always recommend it. So when we're looking at this trade, after we get into this part of the strategy, it gets pretty simple, so to speak. So after we tap into that 4-hour zone, which we have right here, right? We first tap into it right there. So we move up, we take liquidity, and we take liquidity again, right? Now, there is high impact news this day, right here. And we don't want to wait. We don't want to trade when there's high impact news. Again, that's part of the rules. So you would want to wait after it. So, let's say price had came down here and we're consolidating, and you would have had maybe a break of structure right there. Because again, we came down, took the low, took it with displacement. So you might have said, okay, well, I'm going to set a limit right here. And that would usually be okay. That's how you should trade this strategy. But if you're trading this strategy the correct way, we don't trade it with news. So in this example, let's say you had it right there, and maybe you left your position open. You can see it got pipped out right there, and that would really suck. So again, you would have canceled that limit because it hadn't hit and news was about to drop. So just because you don't have that limit doesn't mean you're not going to be able to get in the trade. So this is where we get into our execution part of the strategy. So after the price is traded into the 4-hour zone, you want to wait for a tap and a sweep. So we never want to just trade the first tap. So let's just say price comes into our zone like this. Even if it takes structure, we don't want to trade that. And sure, you might miss out on trades. So if you just hit the zone, you don't want to trade that. And I'm not saying even if there's a low up here that gets swept, what I want to see is our entry model occur within the zone. We don't want this to happen like this. We want it to happen inside the zone. It's very, very important. No raid, no trade. So after we get that tap and sweep, what we want to do is we want to set our limits on the 15-minute range that broke structure. So again, if we're looking at what range broke structure, the first one that broke structure was right here. Now notice how I'm not marking out this last candle. I'm not marking out this wick. I'm not refining anything. It's the last little sell to buy range. Again, it's the same thing as we were talking about before. You have internal high, internal low. This whole range is what caused the up move. So that's where we're going to look to enter. We're not trying to refine this down to the 1 minute. There's nothing wrong with that. This strategy can be refined further using a 5-minute, 1 minute, 3-minute, if you like, whatever. Again, it's stuff for you to test and to figure out what works best. But for this strategy, in order to keep it simple and very mechanical, we're going to just use the entire zone. So now, if a second displacement occurs and the limits are not hit, set limits on the range that created the second break of structure. So in this example, we had a big displacement right here, and this was our zone. Now, obviously the trade didn't come back into it. Somebody's going to say, oh, well, it hit the fair value gap. And this is where hindsight will hurt you if you try. There's always going to be a perfect entry, because then you're going to see this and say, oh, next time I'm using the fair value gap. There went your strategy. And I love fair value gaps. I'm not saying there's anything wrong with them. I'm saying for this strategy, we're playing by the rules. Again, after we have that first zone, we have that displacement again. So this big push up, we're just going to play that whole little down move. Because again, it's just same ideology here. We had this down move that created a break of structure. Down move that created a break of structure. So you're going to put your stops there, or your limits there. Now, we're not going to chase it past this. If you notice, there might be more entries, this and that. But after you get away from that, for one, they get stopped out more often, and 2, your risk to reward is decreased. So what are we going to target here is going to be, if you'd like, you can target opposing 15-minute liquidity. Now, the other target is going to be our 4-hour liquidity. So this up here, the higher point. So that's where we target up there. And you can see this trade took a while. It was also probably pretty stressful in this part because you're sitting there thinking, oh God, you know. But look what price was going back to. Back to that last little sell to buy range. That's going to be an order block. So a lot of people will say, oh, this is the only order block. It's not true. The entire move down is an order block. Go watch ICT month 4 if you don't believe me. That's price was just doing a normal thing. Now, another thing I want you to notice here, let's say if this move, it only went 1 to 1. Now, let's say if it did go 3 to 1, a lot of times you'll still get a push back down because look what price was doing. It was just coming back down to this order block. So that's normal. That's why we don't want to move our stops to entry. That's pretty much the whole trading plan. And that's really it. Again, I want you guys to take this and spend some time testing it on your own. I want you guys to, again, the main takeaway is that you need to develop a trade plan. If you can't do this and you can't put it into words, you're not ever going to have an edge. You will never be consistent in the long run. You might pass a challenge, maybe even get to a payout. You might be profitable for a little while, but you're going to be a boom and bust trader. So if you're at that point where you have learned the technicals and sometimes you'll do really good and then you just erase it all, it's because you're not defining an edge. So thanks for making it to the end of the video. If you want access to the private Discord, use code CASPER, all caps, to start your free trial. That's where I provide my trade signals, teach my private classes, and you have access to one of the best trading communities out there. I really appreciate you guys taking the time to watch my content. And if you ever have any questions, feel free to hit me up on any of my social medias. They are all down in the description with the link to Playbit. Have a great day. And remember, if you can't see the liquidity, then you are the liquidity.